Welcome to these key useful concepts for investing. In a nutshell, we will try to cover certain tools that we can use to be aware for beginners, for starters, how to approach the complex issue of investing. First, we are going to address how to start, which is the very first step, to be aware of some key facts. Second aspect would be describing some key useful concepts for investing. Is the purpose of this small webinar. And finally, in section 3, we are going to be more aware using numbers about the trade-off between risk and return. Finally, we will try to reach some conclusions. Well, how to start? How can we be aware of our reality? We are just humans. This is the first very humility lesson, in the sense that we are limited in our capabilities. We are limited in our capabilities. We don't have vast, wide knowledge. None of us. In order to be more precise about this, we can tell you the following. We all have certain irrationality, some point of irrationality. We are just, human beings, in the sense that we all have certain biases. All the branch of behavioral finance is here, which of course we are not going to explain given the short video we are in. The second aspect I would like to mention is that, however, we do have certain useful tools, as for example technical analysis or fundamental analysis. We can be helped by some tools, but they are imperfect. Remember, they are imperfect ones. Okay. Third aspect, we don't know which is the stock price of Swisscom tomorrow, or Telefonica, or Deutsche Börse, or Microsoft. We do not know how to predict accurately the future evolution of prices. We are just humans. Fourth aspect, that doesn't mean that you have to throw the towel. We have certain possibilities, certain useful concepts that we can use for our purpose, for our good performance in capital markets. Let's try to cover these key useful concepts for investing. We are going to talk about four key useful concepts for investing, 4 useful concepts that will help us when making our decisions about financial markets. The very first concept could be risk and return. Return of an investment measures the good or bad performance of an investment in capital markets. We all like high returns. I like to have very high returns. All investors do. Let me tell you an example, an easy example. We have this investor who invests 100 Swiss francs now, and at the end of the year, she or he would prefer to obtain 135 rather than obtaining 110. We all prefer 135 Swiss francs rather than 110. But this is only part of the truth. The other side of the coin would be risk. Risk of an investment measures the possibility of losing money, and we all like to have a very low risk. We don't like to lose money, right? In this very easy example of investing 100 Swiss francs now, we all prefer to have more than 100 Swiss francs now rather than obtaining less than Swiss francs at the end of the year. So we all prefer having more money than less, as simple as that. But the key problem arrives when we mix together these two concepts, risk and return, because they both usually move in opposite unfriendly directions, in the sense that as higher return, we have a higher risk. And the friendly undesired idea would be to have the high expected return with very low risk, but this is not common. Let me try to be deeper into this. Risk and return move in opposite and friendly directions means that if we have here return and we have here risk, capital markets usually move in this direction. Of course, we all know we like this position, right? We all like this very high return with a very low risk. But this is not reality. Reality means that we have some financial products here, some financial products here, and some financial products there. We don't have financial products with very high return and very low risk. Some schools and factor risk and so on are talking about this, but the basics, the pillar of financial markets is that risk and return move in opposite direction. You may tend to think the following. You may tend to think, well, thanks, Jose. Thank you for the graph, but this is just, one small guy there and one line you drew there. What about reality? Well, this is reality. This is reality where you have stocks here with very high return and very high risk. Please don't forget this. And also some other products as treasury bills, which they find very low return with very low risk. We have some other financial products as bonds where they are like in the middle with middle risk, middle return. So there is a wide variety of financial products where you can choose, but please look who is here. No one. You cannot find that magic solution. Again, this is only part of the truth. In fact, it's bad news, but we can also complement this first key aspect with some other aspects. Let me tell you about the second one. The second key aspect is liquidity. And what is liquidity? This is liquidity, right? Liquid. Well, when we talk about financial products, liquidity means the easy way you have to convert a financial product into money or money into a financial product. The easy way to do that. As higher liquidity, more attractive is my investment. I don't want to have a very nice financial product if I cannot sell it when I want, or if I cannot buy it when I want. And then financial products move in financial markets, and we play a key role here. Okay? It's an abstract concept, but very useful. By the way, this liquidity from the point of view of the investor is given. I cannot decide about my liquidity of my financial product. This is given to me as an input determined by the market where the chosen financial security is listed. Okay? Okay? If we are kind of comfortable with this, let me tell you about the third key aspect. Preferences. Usually forgotten, because we all are different. We all are different. And different preferences play an important role when choosing the composition of the portfolio we're trying to build. There are no right or wrong choices, only individual preferences. Let's talk about an investor. She or he prefers a very high return, wants to go up in the scale of return, a little step in higher return, but she or he must pay a large price in terms of risk. Remember? This is prone to risk. I like risk. However, I can be averse to risk. I can hate risk. If I hate risk, that means that I want a very high increase of my return, and in order to get that high return, I'm willing to pay or suffer a very small, tiny step in terms of risk. So small risk, high return. Pepito could be here. We will talk about Pepito later on. And Juanito would be here. Okay? We are all different with respect to preferences, risk and return. Again, risk and return, we are talking about the third aspect, and risk and return is still there, right? Let me tell you about the fourth aspect. The fourth aspect is diversification. Please put your eggs in different baskets, which means that if you want to protect your eggs, you should put them in different baskets. So if one of the baskets has an accident, maybe you lost 1 egg, 2 eggs, but not 100. Okay? This is not, of course, my reasoning. This is not even the reasoning of BME Institute. This is the reasoning of Mr. Harry Markowitz, portfolio selection. Okay? He said, if you invest in one stock, in one security, you are going to suffer a lot of risk. But if you put your investment in different stocks, in different securities, let's say 10, you suffer lower risk. As much securities, small securities you are adding to your basket of securities, you will get lower risk. Lower risk in terms of diversified risk. And remember, this is a magic number, but this is a theoretical number. I cannot tell you that this is 500 or S&P 500, or it's not a concrete number. It's a theoretical number. But again, the bad news about this is that a certain amount of risk cannot be avoided. And we all live in this planet. Yes, we are different, but we all live in this planet. So we better understand that we have to suffer some level of market risk that we cannot avoid, even if you put your your eggs in different baskets. If you are comfortable so far, we have the 4 elements, the 4 key aspects, in a nutshell, that we could describe in a short webinar as this. Thank you. Let's try to be precise about the trade-off between risk and return. It's quite a simple concept, but it could be also a complex concept once you arrive into financial markets. They move in opposite directions. And what we do now is propose you a game. Let's flip 2 coins and see the results. You invest 100 Swiss francs and you flip 2 coins. If you obtain a head, you get your initial investment plus 20%. But if you obtain a tail, you obtain your initial investment minus 10%. Remember, you flip 2 coins. So you could get 4 different scenarios. Head plus head, tail plus tail, head and tail, or tail and head. Wow! This is Confusion of Confusions, the first book about financial markets, written by José de la Vega, 16th century in Amsterdam. Well, let's go back to our game. We have 4 possible scenarios. Remember, you obtain your initial investment plus 20%. If head, you obtain your initial investment minus 10%. If tail, and first scenario, you obtain head plus head, 2 heads in your coins. So you gain 20 plus 20, you obtain 40%. And this is only one possibility of 4. So 25% of possibilities, 25% of probability. This is just one possible scenario. The other possible scenario, or a second one, could be obtaining a head and a tail. You gain 10%. Why you gain 10%? Because if you obtain 20% of head and a tail minus 10%, 20 minus 10, you obtain 10%. 25% of probabilities. This is just one possible scenario. The other possible scenario is that the other way around, you could get a tail and a head. So you obtain minus 10% plus 20%, you obtain plus 10%. This is 25% of probabilities again. And the last possible scenario is to obtain tail plus tail. Minus 10, minus 10, minus 20%. You lose 20%, and this is 25% of probabilities. If we all understand this game, the average would be to earn money or to lose money. Well, the expected return of this game, and this is the easy part to measure. The most difficult part to measure is risk. We will talk about risk later on. Is the following: 0.25, 20% of obtaining 40, and 25 plus 25, 50% of obtaining 10%, and finally 25% of losing 20%. The expected return of this game is obtaining plus 10%. So as an average, I would gain some money flipping these two coins into the air. But we have a certain risk here, and let me be precise about this. If we have here 50%, and this would be 35% and this 15%, then we would get a negative expected return. So we are only talking about return. The expected return of this game is a positive. But one of the key parameters here in this equation is this probability. If we have a very high probability of losing money, then as an average we would lose money. In fact, we are not talking about risk, we are talking about expected return. The risk part measured by the standard deviation, and in order to be clear about standard deviation, we would have to dedicate some more minutes. We don't have, unfortunately. Is the, let me tell you in one simple sentence, the variability you have of prices along time, the risk you can fall in is measured by a statistic which is named standard deviation. And the number obtained in this game is 21%. Okay? The only purpose we have in this short nutshell is you to please understand the expected return of this game. Pepito is looking very focused in this game, and he's thinking about it. I hope you do too. Thank you. Let's try to cover some conclusions. Before, we have been describing some key concepts. The very first step we should be aware of is, remember, we are just humans. We are just human beings, which means that we, as Pepito, are limited in our capabilities. However, some key concepts, their simplicity and their complexity, can be useful to understand capital markets, their advantages and disadvantages. Advantages could be return, disadvantages could be risk. Remember, risk and return is the very first idea we have been describing. And they move in opposite directions. Of course, we are like very high return with very low risk. But as we have seen in the previous map of financial products, this is not easily found sometimes, most of the times. The second key aspect is, remember, this bottle of water. liquidity. It's not easily found sometimes. The easy way we have to convert financial products into money or money into a financial product. As higher liquidity, more attractive is my investment. Third pillar, preferences. Either if you like it or not, we all are different. We all are different. Regardless of your passport number, your city, your family, we all are different. Even if you belong to the same family, two brothers are different, two sisters are different. And this translates into financial markets also, trying to find preferences about the risk. And you can be averse about risk, or you can love risk. We all are different. And remember, in financial markets, we have millions of people. And finally, I would say, last but not least, we have diversification. Please put your eggs in different baskets. As long as you put your eggs in different baskets, you can be protected yourself. You can protect your investment. Of course, this is a very short nutshell, but I hope this is useful for your investment decisions and for your life. Thank you.